Hello, everyone. Welcome to today's session. Let's just jump right into it here. Market conditions remaining mildly bullish in this bull market. We'll spend a little bit of time digging into that. Also looking at some price pattern activity that we've got happening right now as well. The shorter term momentum indicator, we're just sitting kind of stuck in that range bound location, and same with breadth. We've moved down into this lower level and now moving back the other direction, at least in the short term, off of some of the shorter term sentiment bounce, sentiment in that upper extreme range as well. As far as understanding some of these indicators, these three on the directional alerts page, the quick glance guide is kind of this upper one right here where it says the short term market timing signals, and this is the blue line is giving you the sentiment. The orange line or red line is giving you the momentum, and the green line is giving you the breadth. So once you have kind of got a general idea of what these indicators are telling you down here, you really don't need to spend much time down here because everything is already posted on this chart now, unless you want to see kind of where it's at in the slider, obviously. So this middle of the range on momentum, middle of the range on breadth, it's a counter trend off of these lows. So we've sunk down to these lows, and then we're moving back this other direction. Now, this is the two things I want to talk about today primarily. Is this a counter trend bounce? Counter trend bounce meaning, let's say that this is our trend direction, and this is a counter trend. It's moving the other way, the opposite direction. If this is the trending direction, this is counter trend, and we typically look for a bounce or some support and then higher. The other direction is true as well. If this is the trend and we start to counter trend back up, this is counter to this trend, then this is the overall trend direction down, and this is about to happen here. So what we want to look to see is, are we in this situation or are we approaching this situation right here in the shorter term on really all major markets? Now we've got some Fed data coming out this week. I believe tomorrow that'll definitely be market moving, because they're going to be talking about inflation and interest rates. Those have been the two biggest things that have been happening really the last 4 years, ever since COVID. And we had just a real flush of money, really low interest rates, and flooded the system with that excess money, pushing around goods and services, bidding them up, creating inflation. That's what it does. Too much money, not enough goods in the system, and you get more dollars pushing asset prices higher. Goods and services, everything moves higher when there's more money in the system. So when the Federal Reserve keeps interest rates higher, their intent is to take money out of the system. Okay, you think about with the bond yield curve. We've talked about this before. On the short end of this yield curve, when you have interest rates that are high on the short end, this is, for example, a bank is at 5% interest rate on your savings account, but they're paying out, on a car loan or something like that, they're paying out maybe 4%. Okay, or I should say they're earning 4%. So they have to pay out 5 and they're earning 4. That makes banks unprofitable, and they're not going to lend out as much money, therefore slowing down the lending, therefore not as much money in the system, making it harder to borrow money. That's ultimately what the Fed has to do across the board, for consumers, for companies, for everyone, is to make it harder to put money to work, make it harder to get capital, so that capital can be deployed and push asset prices higher. Same with mortgages. Mortgages are higher inflation, a deterrent for us as consumers to go refinance, pull that money out of our homes, that equity out of our homes, and go spend it. Right? It's harder to do that, or we don't want to do that because interest rates are higher. So that's kind of the real big picture. There's definitely more, minutia when you come to what's actually happening, but in general, that is what we're dealing with. So in the shorter term, the Federal Reserve and interest rates are definitely a topic right here. Now let's jump right over to the S&P 500. I want to just look at the ETF here, SPY. We talked this morning in the update. This is now the counter trend. This is the question. Is this now the new trend direction, and we are counter trending that back up? And this is resistance right here at this area, and we're going to move this direction. Or is this still the trend direction? And now we've just counter trended to that, and now we're about to move higher. Okay, that's the $1,000,000 question, I suppose. Now, some context to this. We obviously know that the big picture, the very big picture, is on direction alerts is this 20-year chart, and we know that we're at the upper end of that range. Here, we're starting to see this little bit of a black line just right there where it's starting to pull back. So if I were to kind of highlight that, that's where we're at, okay, in terms of our retracement. It's pretty light so far, but will it turn into this? Will, this first part, will we counter trend up, and will we get a deeper retracement and potentially pull back all the way to some support areas right here for more springboard higher? That's where there's some uncertainty. There's no doubt that we're at the upper end of the range. We need to retrace some of that, but the probability of a lighter, shorter retracement and then more upside, is there enough excitement and demand and for FOMO, fear of missing out, for new buyers, new demand to come into the market even on a really light pullback? Okay, or are we going to get something like this where we retrace back down again? This would have been last year. So this range is this range on this chart, kind of curled down, and then we started to move back up, got up into this 20 range. We're still there. Again, this is a really slow moving indicator. So are we going to get a whole lot of sideways chop through May, June, July, and August? Probably so. That's typically seasonality. May gets to be a little bit lighter, a little bit slower. So we're also fighting seasonality now. Going into summer, the phrase sell in May and go away is often talked about because summer is here, volume gets light. It's not always the case, but we definitely are there. I'm going to bump this out to the 1-year time frame because I want to look at this range as well on SPY. Now, this as we move out the time frames, we go from the 1 year to the 2 year. Okay, so this 2 year time frame now allows us to see what is the trend of the 2 year time frame. So this does reach all the way back to these October lows and to our most recent highs. That gives a little bit different perspective of the duration of some of these retracements, the duration of some of these retracements, and then obviously the one that's freshest in our mind is this one right here in this last counter trend. So what's this going to turn into? That's the question. Should we be super excitedly bullish to the upside? I don't think so. Should we be really fearful to the downside? I don't think so yet, unless we start to see earnings really bad and we start to see the Fed not do anything tomorrow and say that things are bad. If we start to get additional catalysts over the rest of this week and into next week, especially now that we're in earnings season, that could move the markets down on this 2 year time frame, we could retrace again. We're still in the momentum zone all the way back down to 483. We're still in an uptrend, so we could retrace, get a third part retracement, get an A, B, C counter trend, pull us back into these ranges. That's still a pretty decent retracement. If we were to look at 483 on the 6-month time frame, if we go back in here, back to 6-month 481, 483, that puts us right about a 382 retracement on a 6-month time frame, which is also not that deep of a retracement. Right around here, that's that three-part retracement from here to here, and then more upside, right? So we're working on a counter trend. We're working on a correction right here. Is it gonna be a light one at this area, or is it gonna be a little bit deeper one, or is it going to be a full-on trend reversal and shift to the downside? Lots of uncertainty right here as things are developing, and we want to keep an eye on that. That's just kind of the technical side of things as far as my interpretation of it. The Dow is also this resistance area right here. That stair step works the other direction. Okay, when we're moving higher and we're breaking out here and we're moving up and we're retracing and we're moving higher to the downside, it does the same thing. Once it breaks and comes up here, okay, and now we're having some trouble getting through that on the Dow. That's telling us that there is selling happening right here, and that means more people are piling in for shorting, more people are taking profits into rallies. buy the dips and sell the rips. Sometimes is another phrase that's, a rip is just to move higher. So in this case, we'll see. We're not there yet, but we're right at an area that things could come unglued. And this could be a counter trend. This is that first move higher. This is up. If it's a deeper retracement, this often becomes a C wave down. This is a C wave down. This is A, B, C of a three-part counter trend. This one's usually pretty aggressive, and it can be a pretty fast and painful sell-off. If there's more to come, and it's going to happen sooner than later, and it's a wave C of a counter trend, moving lower, it'll be interesting. It could be fast and it could be aggressive. So that being said, what do we do in these scenarios? Well, we already know, again, we're at the upper end of the trend here. The probability of going straight up from here, something like this, is very, very small. Okay, that probability, especially in a market right here, especially where interest rates are high, that the probability of this just continuing to move higher, crazily higher, is very small. It's not impossible. Certainly could happen, at least without a retracement. From these levels where we're at levels now that we could get support. We needed that. We at least needed any kind of a retracement to break this uptrend and then start to see things. So now we've got that. So now ultimately what we've got is this overall uptrend broken, and now we have these support areas here, this one that was broken and this one that's being retested. That's really the state of the market right here. So going back to what do we do? Well, it depends on your time frame. Okay? Going back to old school asset management and risk tolerance. Typically, rule of thumb is you should have 3 years of income in cash. That seems kind of high for some people, but let's say you earn $50,000 a year as an income. Best case scenario, you should have $150,000 in short-term savings to be able to weather any kind of downturn. Now, and then longer-term assets into equities and into other different areas that you want to be able to try and grow that money faster than short-term interest rates. That's the challenge that we have right now. Is it's going to be tough for the market to outperform short-term interest rates for a while, especially if it's volatile and especially if it's trending lower and you have the ability to sit in cash for 5% or even 4 or even 4.5. Okay, whatever cash is paying is probably higher than the risk of riding out a retracement, okay, and potentially having some drawdown in a portfolio of 4, 5, 6, 8, 10%. Okay, now those of you that are continuing to add in, we're continuing to add into the wheel portfolio where we're having some that are moving higher, some that are flat, some that are dropping out. The market conditions, when we get into these situations, we just want to have less holdings and smaller holdings. We're trading smaller, larger cash positions, stocks that are still trending, because in theory, we still should get things that are moving to the upside. Right now, we've got basic materials and steel that's moving higher. We've got oil and gold that's moving higher. Basic materials, those things are all moving higher while other things are moving higher, lower, but they're also going to be volatile. Okay, you're still going to have gold stocks that move up and down and have some volatility over the course of 2 or 3 weeks. So the way that we want to be able to control that is with the position size, the slice of the pie. How big of a piece of that pie is invested of all of our money allocated towards trading stocks into that one stock? Okay, and if this drives you crazy, or if this is too small, well, then equities and go to Vegas, right? Go somewhere where you can gamble. It shouldn't be in this environment with long-term assets that you were trying to grow. Okay. Now, speculation in stock trading and the world of stocks and options, that's a part of the deal as well. That's what we're doing. Is we're anticipating, we're speculating that whatever this stock is, this company is going to continue to go higher. If that doesn't happen, then we've obviously got to have some risk controls in place to be able to set some stop losses and other things. But ultimately, this is what we're looking for. We're looking for stocks that are marching higher. They pause for a minute, they find support, they move higher, they pause, they support. Eventually, they're going that's going to stop. But there's going to be a handful of stocks that just continue to do that. Typically, those are found in this muscle stocks group. You can scan through the muscle stocks, or you can sort through this new buy list and look to see through the new buy list which ones are there that maybe have setups that are attractive to you in this environment. Okay, you're seeing some stocks that are continuing to move higher. You've got a real estate stock that's here. We may start to see some stocks start to move that are anticipating interest rates to start to drop. And that'll be interesting to see also if that happens as well. But that muscle stocks and new buy list, you're seeing a lot of really good names in there, but a lot of this, okay? They either haven't moved or they've moved just choppy sideways. If they're holding up, if they're good solid stocks, or if they're not and they're just weakening, once that 236 on a 6-month time frame starts to get broken down, that's typically what we're looking for the exit, or a stop loss location as we're trailing that stop loss higher. So as far as risk parameters, which should always be the number one analysis, okay, is how much risk am I taking? The market is going to make the money, okay? The stock is going to move up or it's not. We have no control over that. There's no reason to think that we're smart or cool or whatever because we pick a winning stock. Stocks go up. That's what they're designed to do. If they go down, we don't want to be in it. We're going to stop out. Whether or not we pick it right or pick it that, it's not a competition. It's about what works for us in our risk tolerance and our portfolio levels, and do we have a systematic way to be able to enter into a trade and follow it through all the way to some type of desired outcome, an increase to the upside, taking a profit, or an undesired outcome, which is our stop out. And that stop out is still a desired outcome. Now, I don't consider losing money on a stop out. A stop out is just the allocated risk that we've assigned to that trade. So if we get stopped out, we didn't lose money. We followed our plan. Okay. If we don't follow our plan and we don't stop ourselves out and we're losing more money than our trading plan requires inside of a stop loss, then we're losing money. Okay. The amount we have to risk to be able to get into a trade it's just the cost of doing business. It's just the potential cost that we may have to pay in order to get a potential higher return on that money. It's mentally that way. I don't know, sometimes it helps to be able to realize that volatility and drawdowns and ups and downs and gains and losses and all of those things, that is a natural evolution of a portfolio and a stock. Have you ever seen a stock portfolio look like this outside of what was the guy, Bernie Madoff's fund, that kind of little hiccup and then it went up, little hiccup, went up. It just went straight up forever, 15, 20% consistently. It's because it was fake. It was a Ponzi scheme. That the reality is portfolios go like this. Okay, they're going to be a lot. Maybe they go down a little bit more and up. So this retracement from this high water mark down to a low, let's say that your portfolio was 30K right here, and now it drops down to, 26K. Okay, that volatility, that's called a drawdown. A drawdown is where your high water mark is and your portfolio value is dropping. You've all experienced this in some form or fashion in portfolio, in 401k money, retirement money. You get the statement, you don't do anything, you get the statement, you open it up, you look at it, it's like, oh, I was at 32,000 last quarter and now I'm at 26. Oh, okay, well, that stinks, but I'll open that envelope in another month or two. Our longer term money, for whatever reason, that tends to be our approach. When we start to make individual trades and we're dealing with the brokerage account, we tend to just hyper overanalyze everything and take too much risk, or not understand the risk, or take too many trades, or have no system or no plan. Okay, and that just creates more chaos, and it creates a lack of consistency. Now, anytime you have a retracement like we have right now, we're going to have drawdown. We're going to have retracement. Oops, where'd I go? I didn't want to go here. I wanted to go right here. Okay, when markets do this, this is just the scenario. These times are fantastic. Try and make hay while the sun is shining. And when we're dealing with a retracement, if we're trying to get the same results that we got right here and we're wondering why we're not, well, it's just simply a function the market is retracing. That's it. No other reason. The market was going to control a huge percentage of the overall outcome of a stocks move as well, even if it's a non-correlated type of stock like oil or gold or anything like that. They're still going to, in a market downturn, the baby gets thrown out with the bathwater, the good and the bad. And that's why a lot of real long-term value investors want big market moves lower, because everything gets tossed out, and it creates some really good values when you get mass selling across the board. So we're not there yet, but I want us to be aware of where we're at in this scenario and managing risk accordingly. It's okay to be in cash. It's okay to be 30% in stocks or 20% in stocks or whatever those scenarios are, so that you're comfortable with any future volatility. Or even it's like, no, I want to be active. I want to engage in this. And I really believe that over time we can outperform the market. And in order to do that, we have to trade, and we have to be in the market, and we have to continually be in the market all the time. Okay. At least for this methodology that we're using, because we may have 2 or 3 or 4 stocks out of this portfolio that really continue to hold up the entire group. Got some losers in there, got some winners. We haven't had in the last month or two any real big high flyers. That's just market conditions right now, and that certainly can be a frustrating time frame to deal with. So if you're feeling that and noticing that, it's just a function of the market right here. We wait for it to get back into a little bit more solid uptrend, and that can also be a part of your trading plan. I mentioned this last week. Is don't add anything new, or even lighten up your positions depending on how many holdings you have if the buy sell ratio is less than 1. Okay, so right now we're down here and we're sitting at, let me get this, 0.65. So we're still less than 1. You can see we are working our way back together. So this is bearish. This was extreme bearish. This is bullishness working back together, but that is not new. Okay, that happens. It happens often when these first moves higher take place, and then you get a pullback, and then you get the next one. Okay, so that's where we're at. I'd be very cautious in the market with the markets right here where they're at, especially after tomorrow. And if the Feds don't move interest rates or give a date, markets are probably going to not like that. And we may get some additional earnings reports that are not great. So keep an eye on the price activity. Really, all the data. There's a lot of data that's out there. We don't need all of the data. We don't need to understand exactly what the Fed's doing. We don't need to understand exactly what all the earnings are doing. It's nice to know those generalities, but the market tells us that story already. Okay, for whatever reason, the market is just not satisfied with what's happening, and that red color and that downtrend is telling us that we need to be paying attention to this current trend, this current resistance area, and we need to manage the risk to the downside. Now, if that continues to retrace lower, then obviously in a portfolio setting, we're going to continue to add into a little bit smaller position size. Okay, so the trade today, which was VSTI at 1.5%. So I went pretty small on this one, 1.5% allocation, which is $1,500 on a $100,000 account. That's $150 on a $10,000 account. So relatively small trade. That's what we're doing. We're still trading quite small right here. You may say, well, why even trade at all? Don't. If you don't want to, if it's pointless to put anything in at this point because markets are retracing, then don't. Or if it's becoming too much to manage, or again, if you're entering in and it's like, man, this thing I just bought it and it's immediately retracing. That's the market. That is this market condition right here. So you can wait that out. Conditions will be, when conditions are green above red, those are the times to really be focusing on new uptrending stocks. So if that's kind of the fade, that's one strategy to utilize with this system, is wait for this. Okay, wait for that, and then buy muscle stocks when that looks like that. Now, it was a little bit harder the top end of that range. We got really big moves, and then there were still a lot of gains right here to be had. But even then, really since January, we've been relatively flat for the most part, up slightly in the portfolio, maybe 3 or 4% is all so far this year. And And that's, that's nothing fantastic, but that's what the market has provided. Okay, that's just what market conditions are doing right here. Okay, I'm going to, let's see, let me just summarize here and kind of go back in market conditions, watching for what happens with the Fed tomorrow, primarily not what they say, and it's going to have to do with interest rates, but then watching this resistance, watch how we react today and tomorrow around this zone right here. If we close up above it, we're going to be still probably in the hold range because we're just about back into red right now. If we were to slide back a little bit, if we had a good solid update, it may take a couple of days to put us back up here, but this resistance is going to it's going to cause some trouble. It's a big one, and if we can break above that, that's a good sign. If not, it's more confirmation that we're headed lower from here as well. That's going to do it for today's update. Everyone, I sure appreciate your time and effort, and we'll see you next time. Thanks a lot. Bye now.